Irrecoverable debts and allowances. Today we are looking at irrecoverable debts and allowances. When you are conducting your business, either providing a service or selling goods, over time you are bound to provide your services or sell your goods on credit. This creates a trade receivable, which is an asset on your statement of financial position. As a business, you are required to classify the receivables as an asset if it is probable that this receivable will be recoverable, meaning that the customer will pay the amounts due to you. However, over time, some of these customers may fall into difficulties and they may not be able to pay you what they owe you. If a debt is definitely irrecoverable, then it should be written off as a bad debt in the income statement in accordance with the prudence principles. The bad debt is an expense because to reduce the amount of profits which you anticipated to make in a particular period. So this is debited to the income statement and the trade receivable is credited to reduce what is owed to you, simply to show that at one point you were expecting so much, but your receivables which you're expecting has reduced because somebody, one of your customers, will be unable to repay you. You may at times see the debit entry being made to an irrecoverable debt expense account. This effectively is the same thing as debiting bad debt expenses and crediting trade receivables. Let's now take a look at an example. Fightco has trade receivables at 31st December 2007 of 65,000. A review of customer files indicates that two customers, Ali and Tyson, which owe 7,000 and 8,000 respectively, have gone bankrupt and their debts are considered irrecoverable. We are required to calculate the balance carried down on the trade receivable account at the end of the year and to calculate the bad debt expense, which will be shown in the income statement. Since both Ali and Tyson have gone bankrupt and it's definite that they will not be able to pay back, Fightco needs to open a bad debt expense account. So the bad debt expense account of the total of 15,000 is opened. This will reduce the trade receivables of 65,000, giving a closing balance of 50,000. The bad debt expense is then closed to the profit and loss, where it goes as an expense to reduce the expected profit for the period. Where a debt is possibly irrecoverable, an allowance for doubtful debts account is opened. Since there's a potential recoverability of the debt. So this new account, known as an allowance for receivables, will offset the trade receivable balances in the statement of financial position and the expense taken to the income statement. So the receivable will still stand at the original amount. However, it will only be offset by the allowance, which will be a different account, also which sits on the statement of financial position. So accounting treatment will be to debit doubtful debt expense and credit allowance for receivables. Again, an irrecoverable debt expense account can also be used for the same purpose. We continue with our earlier example. Now in this example, after reviewing its files, customer files, FICO figures out that there is some uncertainty as to whether a debt of 3,500 owed by B will be recoverable. You are required to calculate the allowance to be shown in the statement of financial position and calculate the doubtful debt expense to be shown in the income statement, and then to show the information from the two examples, example 1 and 2, how these will be shown in the income statement and statement of financial position. Since the 3.5, there's uncertainty there. It could be paid, it could not be repaid. So we open a doubtful debt expense account. So the doubtful debt expense account will be debited, and then the allowance for receivables will be credited with the 3.5. This 3.5 in the allowance for receivables will be netted off from the receivables account in the statement of financial position, while the doubtful debt expense account will be posted to the income statement, where again it goes to reduce the profit for the period. So in the income statement, we'll have the bad debts of 15,000 from Ali and Tyson, and the 3.5 doubtful debts, which in total reduce the profit by 18,500. However, in the statement of financial position, the trade receivables will be netted off against the allowance for receivables to give us a current asset trade receivable of 46,500. We now move to the type of allowances. There are two types of allowances. There is a specific allowance, which is provided against a particular or named individual customer, and also the general allowance, which is a percentage applied to the total trade receivables after you've written off bad debts and you've deducted the full balances of any customers for which specific allowances have been created. The order in which the general allowance, the order in which you write up the trade receivables accounts, is that you first write off the bad debts. No, first you write up the trade receivables account and credit sales and cash received in the period. Then you write off any bad debt expenses by debiting the bad debt expense and crediting the trade receivables. Then you follow up this by making any entries for specific allowances. You debit the doubtful debt expenses in the income statement and credit the allowance for trade receivables. So in your workings, you're going to calculate the general allowances on trade receivables after the bad debts have been written off and after excluding in full amounts for which specific allowances have been made. Let's illustrate this. So let's assume our trade receivables are 100 and we've got a specific allowance of 20, so we're going to write off the specific allowance of 20 from the total trade receivables to give us a balance of 80. Then we apply the 5%, again it's an assumption, 5% general allowance against the 80 to give us general allowance of 4. So our total allowance will be the 20 plus the 4 to give us 24. Let's look at a more illustrative question. A business trade receivables account showed a year-end balance of 47,440. It was decided that amounts totaling 340 should be written off as irrecoverable. Okay, meaning this 340 is a bad debt which will be expensed since it cannot be recovered. Continue. A specific allowance was to be made against an amount of 400 due from DICO, a customer, and a general allowance of 2% was to be made against the remaining debts. Calculate the allowance for receivable shown in the income statement, and B, calculate the bad and doubtful debts expense shown in the income statement.